Berkshire Hathaway is sitting on almost 400 billion in cash, the largest cash pile in history. And depending on how you look at it, that is either a sign that Berkshire has become too cautious or a sign that most investors have become too impatient. And you really see both sides of the argument looking on social media. That's really the tension from this year's Berkshire meeting. This was the first annual meeting led by Greg Abel since becoming CEO. And I think a lot of investors were watching for one big thing. Does the Berkshire Hathaway playbook change without Buffett fully at the helm? And based on what we've heard, the answer seems to be no. Greg Abel clearly has a different style. Buffett was more big picture. Abel gets more into the weeds, operations, margins, efficiency, railroads, energy, AI, and how these subsidiaries can improve. But the core philosophy sounds very familiar. Be patient, stay liquid, do not chase deals, do not do something just because the market wants action, and when the right opportunity comes, be ready. And that might sound simple, but it is actually very hard to do in real time because when markets are moving higher, cash looks lazy. Discipline looks stubborn, and patient can look like a mistake until that environment changes.
Yeah, and I think that is the really important setup for the episode today, because Berkshire is almost the complete opposite of where a lot of investors' attention is right now. We look to AI. A lot of people are asking, how do I get access to OpenAI, Anthropic, Stripe, or other private companies before they go public? And I do get it. Some of the most exciting companies in the world are staying private longer. By the time they IPO, a lot of the value might have already gone to founders, employees, venture funds, sovereign wealth funds, large institutions. So retail investors naturally wonder, why can't I get in earlier? And the question is pretty fair. If more value creation is happening before the IPO, then public market investors are right to ask why they're showing up late to the party.
Exactly, but that's where investors need to be careful. Access is not the same thing as opportunity. Just because you can buy a private company does not mean you are getting a good deal. Private markets can come with high fees, poor liquidity, limited information, wide spreads, lockups, and a lot of uncertainty around valuation. And that's very different from buying a public stock where you can see the financials, compare the valuation, and sell if your thesis changes. So today, we're going to look at both sides of this. On one side, you have Berkshire sitting on a mountain of cash, refusing to swing at bad pitches. And on the other side, you have investors trying to get early access to the next great private company. And somewhere between those two extremes is a pretty important lesson for investors, because the question is not just, can I get access? The better question is, do I actually have an edge once I get access?
Yeah, that's the key distinction, because a lot of investors assume being earlier automatically means you have a better opportunity, but earlier can also mean less information, less liquidity, worse terms, much harder time figuring out what the investment is actually worth. That doesn't mean private markets are always bad, but it does mean that investors need to separate the excitement from the actual expected return, because that is what we're trying to do here, is earn returns on our money. And I think that becomes even more important when the companies involved are tied to AI, where the stories are huge, the valuations are aggressive, and the range of outcomes is extremely wide. So a great company can be a poor investment if the price or the liquidity is wrong, too high, whatever it may be.
The other piece we'll get into is accredited investor rules, if we have time to get to that, because in Canada and the US, a lot of these private market opportunities are only available to investors who meet certain income or asset thresholds. The idea is investor protection, but the question is whether those rules actually protect investors or whether they mostly create a system where wealthier people get access to opportunities that others do not. And that gets messy pretty fast, because being wealthy does not automatically mean someone understands risk, and not meeting those thresholds does not automatically mean someone is unsophisticated. It's a very blunt measure and way to measure something that is actually much more nuanced: judgment, risk tolerance, financial literacy, and position sizing.
Yeah, and I think that's the part where the debate is. People can gamble on sports, penny stocks, buy crypto, buy options or take massive risks in all kinds of public markets. But if they want to invest in certain private companies, suddenly the rules say unless you meet a wealth threshold, you can't participate. So is it investor protection or is it just a very blunt filter? But first, we're going to start with Berkshire because I think the meeting gave investors a really useful contrast. Berkshire's not trying to be exciting. It's not trying to win every trend. It's not trying to prove it can find the next hot AI company. It's trying to protect capital allocated patiently and be ready when the odds are actually attractive.
And in a market where everyone wants to access the next big thing, that might be the most valuable lesson of all, because the danger is not missing every exciting opportunity. The danger is convincing yourself that every exciting opportunity is actually investable. So in today's episode, we'll break down Greg Abel's first Berkshire meeting as CEO, the cash pile, the buybacks, the insurance, BNSF Railway, energy, AI, and what Berkshire's approach says about long-term investing. We'll also talk about whether the cash pile is a drag or whether it becomes a major advantage if markets finally give Berkshire the kind of opportunity it's been waiting for years now. Then we'll shift to private markets, how platforms like EquityZen and Forge work, how investors can get exposure to pre-IPO companies, what the risks are, and why accredited investor rules deserve a closer look.
So you have a market obsessed with access, speed, next big thing, and we go over if the real edge is actually patience. Let's get into it. I guess you'll start off with Berkshire.
Yeah, let's do it. So this was one annual meeting that I was really looking forward to. But let's be honest, every year I look forward to it because it's always some nuggets of Warren Buffett that are really useful as investors. But I am a shareholder, so I felt an extra obligation to listen to them.
Yeah.
You own it as well.
Yeah.
And it was definitely Greg Abel's first meeting as CEO. He became CEO earlier this year. And it felt like the Berkshire under Abel hasn't really changed all that much, aside from different styles than Warren Buffett, like we alluded to in the introduction. And it's not necessarily a bad thing. Buffett was more a big picture communicator. He could explain the core economics of a business, capital allocation, incentive, and risk in a really simple way that was very easy to understand for pretty much everyone without getting too deep into the operational detail. Abel contrasts that a little bit, seems much more comfortable going into the weeds, margins, operating efficiency, technology, subsidiary level execution, and where a specific business can improve. So let's get started on the cash pile, because that always makes headline, at least since the cash pile has been growing significantly over the last few years. So their cash pile is almost at $400 billion, although he did make a point that it's probably closer to 380 if you remove a few things, but it's still a significant cash pile here. It's almost 32% of their total asset. And that's a ratio I like to look at, because with inflation and asset valuation just growing over time, an absolute number is not necessarily reflective of how big it is compared to everything else. So that 32% metric was really interesting. It's actually the highest level since 2005. It's a strategic advantage for them given the current geopolitical environment. When you think about tariffs, war, macro, all of that, they are not changing their core strategy, and having that liquidity does offer a lot of flexibility when those opportunities arise. They operate their business for the long run,